Let's welcome in Madhav Dhar. He's joining us this morning. Thank you, Madhav, for taking out time for us. If you could just tell us about valuations of the Indian market. There is always this debate that, enough has happened, markets can correct now. What is your view? Are we extremely overpriced?
No, I don't think so. Obviously, there's been a great bull run both in India and around the world, and things are extended. But, valuations are high, but not so stretched that it should demand some worry. And it's very hard to predict when you might have a certain pullback. That could happen anytime. But I don't know. I'm not so worried about it. I think there's momentum finally picking up in the Indian economy and in Indian earnings. So, and, the reforms are now starting to pick up across the board. So I think that is supportive. I mean, I don't think valuations are helpful, but they are not at a point where they could really be a major headwind at this point. No, I don't think so.
Right. And also, when a big investor would look to exit or enter, any other country or any other space, valuations is the last thing to look at. If the underlying business is doing well or if there is earnings growth which is visible, a little bit of investment would come in.
I think that's hard to generalize. I mean, global investors come in all shapes and sizes and philosophies. I mean, you'll have a certain value managers where valuation is the primary indicator of when to enter or exit a market. And for them, I think valuations are a little bit stretched in India. But there are growth investors or more fundamental investors that will look more to not only the macro dynamics, but company-specific fundamentals and earnings, which are turning largely positive across the board. But they're all kinds. I mean, there's a huge amount of value money globally around the world, and India will not be attractive from that standpoint. So it's hard to generalize that there's a certain kind of investor.
Right. Till 2 years back or maybe 1.5 years back, the key focus was what central bankers are doing. You think markets have moved away from that and now the focus is, what big political leaders would do?
I think so. I think that's a good question. And I think that trend is, I've always maintained that central banks are overestimated, especially in the last few years. But yes, I think the focus is moving away from monetary policy more to fiscal policy, and as a result, also political developments and things like the change in administration in the United States and Brexit, what's happening to separate countries in Europe, France and Germany have very important elections. I think that will make or not make or break, but that will determine the risk premium and the attractiveness of different regions and different countries much more than monetary policy. Yeah, I do believe that.
Right. And liquidity, say if there is a little bit of tightening from any of the major central bankers, markets have factored that in?
I'm not sure the markets have factored that in. So I think, though, that remains one of my concerns, and at the risk of getting very philosophical, I think some very big trends over the last 30, 35 years, not only just the last 5, 7 years, seem to be shifting and maybe reversing. I mean, the big trends towards what we call globalization now, which was basically the opening up of world markets to goods, services, ideas, people, information, and technology, it may not be reversing, but it's certainly dented, and it's being questioned politically with serious consequences. Brexit is a consequence. The rise of Trump is a consequence. The talk about border taxes in the U.S. is a consequence. Non-tariff barriers are starting to go up a little bit. So these are all big concerns. It's all happening at a time where global interest rates, which have been low or zero for the last 7, 8 years, are starting to clearly tick up. So that is a really difficult combination for markets where you have globalization either dented, damaged, or dead, rising interest rates, and the markets at all-time highs. That's a heady combination. So my biggest concern for India, frankly, is global markets. I think within that, India is actually as well positioned as I've seen it on a relative basis in terms of more positive. I mean, the world common markets are breaking up. India is doing GST. We're going the other way. Interest rates are rising around the world, and they may not be falling clearly in India, but there's room for inflation and interest rates to fall. Earnings momentum has been very solid in the U.S. for 3 or 4 years. It's just starting to pick up in India. So I think that even as the global tide starts stalling or receding, the Indian momentum or tide is going a little bit the other way. So that is the complicated countervailing dynamic overlaying India and the world.
Right, but say if the situation happens and there is a lot of protectionism which increases going ahead worldwide, you think flows would come to India, or if investors are losing money in other markets, they would not be willing to invest a lot of money even in a country which is doing well?
Mm. Well, the history of the world is that if global markets go down, all markets go down and emerging markets do worse. So sadly, the history is that, all the babies are thrown out with the bathwater, so to speak. And it may not be any different this time, but I don't think people look at developed countries and emerging markets the way they used to. I think they distinguish between countries much more. So there's a far more globalized, discerning investor now. But I think it behooves India to continue accelerating reform. So we have to do things that really stand out, where people can clearly say, all right, the tide may be going by, but this speedboat is accelerating. Whether it's GST, whether it's the entire digitalization, which is extremely positive in India, whether it is infrastructure spending really picking up pace, whether it's the addressing the NPAs. So there are 4 or 5 very broad areas that India needs to continue to address, which it's starting to. And if that accelerates, that's amplified, that's marketed, and more importantly, that's actually implemented, I think India has a chance to truly separate itself from the pack, even as world markets falter. So yeah, I do believe that, but it's historically that would be unusual. But it can be done. It has been done in the past, but it needs clearly different economic and earnings momentum and a different liquidity landscape. And I think the preconditions of that do exist in India today.
Right. What about the earnings for the last 2 to 3 years?
Snatched defeat from the jaws of victory many times.
Right, but to sustain investments or sustain flows, you need earnings to pick up. And last 2 to 3 years, you've always had some problem in the earnings. At the start of the year, 15 to 20% earnings estimate, and then just less than 5% by the end of the year. Why do you think this year would be different?
Well, I mean, twistedly enough, for the reasons you're saying, I'm just saying that many of the bad things that could happen to margins relative to headline growth are already in the poor earnings performance of the last few years. And I think so some of those hits have been taken, absorbed in the accounting statements. And I think 2 things are happening now. I think both the headline growth is picking up. I mean, you can choose to believe whatever GDP number you want to believe, but whatever it is, it's trending higher. And it's hard to make a case why margins will be lower than they already are. Profits as a percentage of GDP is already been trending at the lowest levels of the last few years. So all the trends tell you that it should rebound to a more normalized level. And to get to a normalized level, it probably has to go above trend first, from where it has been below trend. So yes, I mean, you can always have accidents, you can have massive credit write-offs. I mean, who knows, what is exactly written off in different books. But my own instinct is that margins will move towards above trend from below trend. And that will be a very big positive surprise, whether it's in the next 6 months or whether it's over 18 months, don't know.
Right. When capacity utilization picks up, margins tend to pick up, as you're saying. Whenever the earnings would grow, it would sustain because capacity utilization would continue to pick up?
I think so. I think so. I mean, as you say, you've had such a low capacity utilization that you can have big earnings without big investments for some time, but eventually investing will, the private sector will have to start reinvesting again. And at some point, it becomes a self-sustaining dynamic. I think you need to clean the NPAs in the system, which will be an encouraging sign for the private sector. The government sector has to invest in infrastructure, not necessarily wait for the private sector. And once the landscape is clearer and it improves, GST comes and goes, I think the private sector and the earnings accumulation will start the reinvesting process. So the private sector is probably a year away, perhaps 18 months away from that. The government already seems to be starting, certainly in railways and roadworks and so on. GST will have its own boost. So, yeah, I mean, I see a steady, if unclear and perhaps slow, self-sustaining economic revival and momentum starting in India. And by the way, from reasonably high levels, I mean, whether the growth is 6.5 or 7.5, whatever the number is, this is nothing to sneeze at. I mean, people go on about how low growth has been in India. It's been fine. It could be better, and it will be better, but you're accelerating from reasonably high levels.
Right. Till now, capex pickup, especially from 2004 to 7, was in the entire infrastructure space. And when people used to talk about infra, they used to talk about pickup in power, pickup in all the sectors. Do you think now it will be in a staggered manner? So we've seen roads pick up, we've seen defense pick up. Traditional L&T has seen a little bit of execution pickup. So you think now it will be in a phased manner and not an all-out infrastructure pickup?
Well, probably. I mean, and not to mention what's happening in the entire digital landscape. And because it's not bricks and mortar, it's not measured as easily, and it may not be as visible. But the amount of startup money and general investments that's happening in the entire digital space is also massive. So yes, it's multi-sectoral. This time, probably broad-based. I mean, 2004, 2007, 8 was frankly a one-way commodity-led growth boom, and that's where all the money went. But the world has a way of shifting dramatically, and it has already shifted. You've gone from a commodity boom to a commodity bust, and money and ideas will find new homes. I mean, that's the history of cycles. And this time, I do think it'll be more broad-based. But I think it'll be unclear as long as we still have a massive non-performing loan overhang. Till that clears, it'll not be very visible how much money there is and what sectors it can, efficiently go into. So that big wound has to be cleared up and bandaged before we can walk again properly.
Right. We'll just talk about the NPA issue, but, what do you make of the recent developments in the e-commerce space? So you're seeing a lot of M&A, funding activity has reduced, but it's happening at a lower price. Do you think that'll be the interesting sector in the next 5 years as we get more listings, from whatever funding is being raised?
Yes, I think so. I think one of the things that has happened that I think is still being absorbed, I mean, in the previous tech cycles, let's say, maybe this is perhaps the third big cycle. I mean, you had the whole chip manufacturing cycle in the 80s and 90s, which was to some extent driven by, Apple, the DRAM manufacturers in Taiwan, Intel, Motorola's. These were the big companies. Then you had the internet revolution starting with Netscape, 95, 96. Going into a bust at the end of 2000, and now you have a third massive wave. And I think the big difference is that those were tech sectors. It was just a sector. It was an isolated sector that was, it could be valued alone, played in an isolated way. What's happening this time is all sectors are being affected by technologies. The world is changing far more dramatically in this tech cycle, if you want to call it, than previous cycle. So every bank is a tech stock in one shape or form. Tesla's market cap just exceeded General Motors' market cap. So a company that's not even 10 years old and was being laughed at as some kind of weird experiment, its market value is bigger than General Motors, which is a 100-year-old company. It's absolutely astonishing. So is Tesla a car company or a tech company? Pharmaceuticals, a similar thing is going on. So it's every sector, one in some shape or form, perhaps with the exception of roads, and is a tech sector. Education is a tech sector. So this is massive and it's huge, and I think India is going to be a disproportionate beneficiary of that because it'll help us leapfrog previous technologies. And I think, I thought this 5-6 years ago, but I think what Aadhaar, the combination of Aadhaar and mobile, and which is the cute name is JAM in terms of this Jan Dhan, Aadhaar and mobile, I think it is not to be underestimated. And I think the benefits of that are going to be absolutely monstrous, not only simply in bringing private investment in a multitude of tech-related areas that infect lots of sectors, but even for the government, whether it's subsidy reform, whether it's education, whether it's social security. So I'm extremely, extremely optimistic of what a combination of mobile usage, money flows into this area, and Aadhaar is going to do to the country. I think it's absolutely fantastic. And you combine that with GST and some incremental reform in other areas which are long overdue. Let's say labor reforms and so on, and NPAs. You could easily visualize a serious multi-year boom in this country.
And how do you play this boom? Of course, listings would happen over a period of time, but any way to play them right now?
Don't sell.
Right, and in terms of any consolidation that you expect?
No, listen, I don't know. I think it's very complicated. I think the whole fintech space is going to be very exciting, but it's overcrowded. So, life is never easy. So the same thing is happening as we found out. Look at the last 18 months in the e-commerce space. You've had, the rock stars and fallen angels all at the same time. And the same thing happened if you look at what happened in 98 and 2002. You had, eBay, Amazon, all these companies go sky high, absolutely collapse. They went down 70, 80, even 90% in valuation. And from the rubble of 2002, they've gone up 50 times. So I don't see why e-commerce in India won't be similar. So I don't think one should not get discouraged by these wild valuation changes. That ebb and flow of psychology will happen, but the underlying true economics of this space perhaps is still being underestimated. And it's not the easiest thing to play because a lot of these companies at this point are private, as we know. But as I said, I think it's infecting so many areas that broadly you just have to stay invested, broadly speaking. And I think within that, I think it's going to be a little more complex. I think the mistake one will make, as people do, is to get bullish at the top, bearish at the bottom, and play the cycles wrong and second guess things, overestimate their own ability. I think those are the bigger mistakes. I think exactly which sector, exactly which stock, I think that's a much tougher game and frankly a much less important game. I'm playing it in my own ways, but I wouldn't necessarily recommend it, because some of that is private, some of that is risky, some of those are big macro calls. And I will say the one thing that I have done reasonably well is not to get shaken out at difficult times and double up at important times. And in many ways, panics and big breaks in the market especially in a market like India, where I have been structurally bullish, those panics are great opportunities. I mean, we talked about it on your channel in 2012. Rupee was at 68. Nifty was 5,000. You don't have to be a genius. It's now 9,000. Rupee is at 64. And everybody thought rupee was going to go to 75 or 80. Everybody was talking about it. And if you just kept your head and saying, this is ridiculous, I'm going to buy 11% bonds in 2012 or the Nifty in dollars at 68, that's one of the biggest trades you could have made. I'm not saying it in hindsight. I'm just simply saying that in structural bull markets, to the extent you believe it's a structural bull markets, it's important not to get tempted to sell when things look frothy, and it's important to really double up when things look bad. And you can do, and if you have a special sectoral expertise or a stock you like, you should do the same thing with that stock. But the important thing is to stay on board and not to treat this like a game. It's a full participation life, and it's not a game. And that honestly is my boring, repeated, but I think terribly, terribly important message to your viewers. It's more important to be long Nifty than to figure out exactly which stock or sector is going to benefit.
Right, and double up in tough times or double up in times when everything is going to finish.
Yeah, exactly. I mean, double up is a colloquial word, whatever it is. I'm just saying don't lose faith, and if you have cash, you should add in if you believe. And let's say it's very complicated to figure out exactly which stock or which sector. Don't wait for that. Get long the market, and then you find as part of your investment that you can replace the long the market with specific stocks or specific sectors that you feel you have an edge in or you have a strong belief. But don't make it your entire portfolio, and don't wait to say, okay, I'll spend the next 2-3 years figuring out what sectors I want to be in, and then I'll decide. No, you should be in first and then replace Nifty with different stocks. I'm using Nifty as a catch-all for the market. I think the most important thing is to be long the market. And I think people just underestimate these things. I mean, India has been the second best performing market in the world over the last 10 years, over the last 35 years, in US dollars, second to the United States. I don't know how many people even realize that. And the only way you made that money is you didn't sell, you stayed long. I'm not talking about picking the right sectors.
Right, so stay invested. One thing that you told earlier was that the NPA problem needs to be solved. What do you think, how do you think this is going to be solved? Do you think big haircuts, big capital requirements, that tough call has to be taken?
Yes. I mean, simply put, yes. And I think you need certain reforms within the public sector banks so that the person making those calls has truly a free hand in making those calls, and there is no witch hunt after the fact. So I think you need some corporate level reform within the public sector system. And frankly, the entire public sector system has to become a smaller and smaller part of the economy. And and those trends are underway. More and more bank licenses are being given. I think the whole fintech space is accelerating so rapidly that it'll start taking market share away from everybody, perhaps even including the private sector banks. But I think, things that are most obviously logical in India can be very institutionally and structurally difficult. I mean, you would argue, why do you need a public sector bank? So if you really wanted to reform, they probably shouldn't even exist. But that's a tough one, and it's not going to happen. So next step is to make them much more efficient, much more accountable. And it's no lack of talent in these banks, but you need a decision-making system that is not political and that will not have retribution politically for doing the right things. And they will have to be recapitalized. And it was mentioned as a very small line item in the budget with a very small number by the finance minister, but the reality is it should happen and it'll be a much bigger number. And I don't think there's anything wrong with that. It happens everywhere else in the world. And it's much better to address that wound, even if it's expensive, than to let it bleed. And my guess is if the government comes out and says, okay, here's a huge number and we are recapitalizing the banks, reformulating how decisions are made, et cetera, I think all these stocks will go up, not down. I think the market will be up, not down. So, but we'll see where that goes. I think there's certainly more talk and focus on it, but some of those decisive things have yet to happen.
Once this problem is solved, or there is any credible solution that comes for NPA, some of these large banks like SBI, BOB, the way they are going in the digital way, the way they are, trying to increase their retail book with the brand that they have is quite phenomenal. So once the bad bank or the NPA problem is solved, there is a lot of value in these banks? I think so. That's that's been one of my big investments for some time now. I mean, I think so, and I think their relative valuation is a huge attraction, and they to some extent are being underestimated cyclically. I worry about them longer term because I think they'll have a hard time competing. But State Bank below book value versus the private banking sector at 5 times book. I mean, there's a big gap there. There's a big gap there, and there's a lot of low-hanging fruit for these public sector banks in terms of increased efficiencies and so on. I mean, structurally, the problem they will have is that old-fashioned banking could start disappearing very, very rapidly. So having a huge branch network is going to be less and less important. Having a big brand and having it embedded in people's consciousness in a positive way will always have value. But, Paytm is more front and center in brand consciousness than perhaps State Bank already is. So they've created a brand out of thin air very, very rapidly. So the debate will be, are physical bank branches truly relevant even in small villages in India in 3 or 4 years? And if I had to bet, I would say, no, I don't think they're that important. So that's a big headwind for the public sector banks, where the USP has been a nationwide retail bricks and mortar branch network. That's been their great strength, and that great strength is no longer as relevant in the modern world. Madhav,
So
thank you
that's
so
my
much
conflict.
for taking out.
I mean, short term, medium term, I think the stocks. Yeah.
Right.
Thank you.
Thank you so much, Madhav, for taking out time for us. Always a pleasure.